Good afternoon and a warm welcome to everybody. I am Angelica Kinney, your host for the webinar today, and let's dive straight into it. Today's webinar is all about, can a large cap index behave like a small cap? And to understand this better, it is my pleasure to introduce Mr. Alok Jain. Mr. Alok Jain is the founder of Weekend Investing. He has been in the Indian stock market for more than 30 years now. He's passionate about building mechanical trading and investing models to invest in the markets that can generate superior returns. His dream is to try help others achieve financial independence early so that life can be lived to the full like it has for him. Sir brings both expertise and practical insights to the table with a wealth of knowledge and expertise to our webinar today. Before moving ahead with the session, please know that if you have any questions, please send them in the comment box and we would take those up towards the end of the webinar. Sir, over to you.
Thank you, Angelica, for a very nice introduction and welcome to all the viewers. We're going to talk about a very peculiar phenomena that is happening in the markets, and this is not expected at all. So, the peculiarity is about this large cap index, which behaves more or less like a small cap index when you look at its alpha potential and the historical performance. So no prizes for guessing. This is what we are talking about is the Nifty Next 50 index. So those of you who are not aware of this index, Nifty Next 50 index is basically the 50 stocks below the Nifty index. So Nifty 50, which is the leading index, captures the first top highest market cap, you can say, stocks in the universe, and they are clubbed as Nifty 50 stocks. And the next 50 stocks, so position number 51 to position number 100, is designated as the Nifty Next 50. And both of these together comprise of the group called large cap. So the regulator has classified the entire stocks in classification of large cap, mid cap, small cap, and then perhaps nano cap, micro cap, whatever. So large caps are basically the top 100 stocks. Mid caps are the next 150, so 101 to 250, and then small caps are 251 to 500, and then 500 onwards there is no real classification as such. So that's the makeup of the market structure and the universe of stocks. So when we say that invest in large caps, it generally means investing in the top 100 stocks in the NSE universe. Within this top 100 universe, there is a distinction of the Nifty 50 and the Nifty Next 50 index. And very peculiarly, these two behave very differently. So the behavior of Nifty 50 is very different from the behavior of Nifty Next 50, as we will see in this presentation. So what are the salient features of Nifty Next 50 index? These are basically those stocks that can potentially move to the Nifty as they grow. If they are able to prove their potential, prove their metal, if they are able to become those, premium blue chip high market share companies, then the market will reward them by moving them into the Nifty category. And it is basically this very competitive index where it is a proving ground. It's almost like you are in a college and you have to prove yourself to really get that job to be in the Nifty 50 space, which is the flagship of the country. However, while this is classified as a large cap index, its return profiles of the stocks combined in 50 next 50 is often like the lower caps, like the mid caps or the small caps. So very high growth, but also very high volatility and strong alpha potential. So behavior is very much like the smaller caps, but is classified with the large cap. So let's see the chart of Nifty Next 50. The white line is the Nifty Next 50 chart over the last 20 years. and the orange line is that of the Nifty Small Cap Index. So you can see here that, in most situations, it is as volatile as the small cap index. And over a period of 20 years, it in fact has beaten the small cap index by a wide margin. So 1454% versus 1083%. So this is telling you how dynamic this index is, which is the Nifty Next 50 index. Now, again, as stocks move from small caps to mid caps to large caps, they have to pass through this zone. So basically, this zone is capturing that sweet spot where institutional interest starts to build. A lot of institutional interest, a lot of, let's say, foreign investors do not want to invest in small caps, for instance. There may be some focused funds, but most of them do not want to go into that space in the market. Mid caps, yes, there is some interest, but large caps, there is a large interest to invest in large caps because the large cap stocks essentially are giving comfort to the investors that yes, these are proven businesses. They have risen to this level, so there must be, reasonable backing to that business in terms of management, in terms of quality, in terms of depth of the business, in terms of depth of the volumes that are traded in the markets, in terms of what research is available on those stocks. All that is very different in large caps versus other caps. So when you look at the hierarchy, the strongest of mid caps, like mid caps are 101 to 250, the strongest from this cohort will move and graduate to the Nifty Junior at some point. So let's say some company which is today a mid cap company does reasonably well, grows very fast. In 2 3 years time, perhaps it may move into Nifty Junior, and then it continues to grow extremely fast, and you never know, it goes into Nifty 50 the next year. So the winners are rewarded by the market as their market cap goes up. Market cap is basically the price of the stock times the number of stocks available. So as the price of the stock keeps going up, it moves from one category to the other. And similarly, the other way around. So if there are stocks in the Nifty which don't perform, they will be moved down to Nifty Junior. If they don't perform there and others are doing better, then even large cap stocks can become mid cap stocks. And we have seen enough examples of that. Now, something very interesting to see here. This was a study done by ET, and this is showing you all the stocks that moved into the Nifty 50 uh, and what was their returns profile before moving into Nifty and after moving into 50. So these are all the stocks over the years that entered Nifty. So some of them: Titan, Tata Consumer, Bajaj Finance, Bajaj Finserv, HPCL, Eicher Motors, Yes Bank also. 25 stocks, they delivered lower returns once they moved into the Nifty. So when they were in Nifty Next 50, they were doing really well. But once they moved into the Nifty cohort, they started to underperform. So the average 5 year CAGR for these stocks before they entered Nifty was 35%. They were growing fast, and that is why they earned a seat in Nifty. But once they moved into Nifty, the average CAGR after inclusion became just 6.9%. So this is a very fascinating study of the peculiarity of how stocks behaved before they entered Nifty and after they entered Nifty. And this is not just the one way street, it is the other way around also. So this is the study of all stocks that exited Nifty. So all these stocks, whether it is Tata Power, Vedanta, Gas Authority, Shree Cement, DLF, Jindal Steel, and the list is long. When they were in Nifty, the 5 year CAGR was minus 6%. and that is why they were made to exit Nifty, that these stocks are not performing, so exit. So there is a index committee which meets twice a year, 1st of April and 1st of October. You will find that constituents of the Nifty and other indices, they will change. So the index by itself is a market cap weighted index, more or less, and it behaves like a momentum strategy. So stocks that do well will stay in the index or go to a higher index. Stocks that don't do well will not stay in that index and go lower in the lower cohort. So these stocks that were performing at -6% for 5 years, after they were removed from the Nifty. So obviously, when you remove from Nifty, you will go to the lower cohort, which is Nifty Next 50. There, the CAGR over the next 5 years became 12%. So, because while going up and while coming down from the Nifty, stocks tend to really perform very well in this Nifty Next 50 cohort. And once they graduate to Nifty, they become over owned, over researched, and that that spark is finished by then. So this Nifty Next 50 space, which is still a large cap space, is that that it is that bed of opportunity, which while going up as well as coming down is getting very active on these stocks. So there is a higher dispersion in performance across stocks when they come towards this particular segment, and it becomes a sort of a very natural option to use this segment for momentum based approach. So if you are doing momentum investing, which requires strong trends in the stocks to form, then this particular segment becomes a very ideal location, because stocks that are in this cohort tend to move up, and stocks that come into this cohort from the top also tend to do well. So the other issue that will come here is perhaps just like small caps, high alpha will also be you will always have high volatility associated with it. So you can't have the cake and eat it too. That kind of a thesis is there, that if you want high alpha, then those high alpha stocks are also going to kill you with some high volatility. So it's a double-edged sword always. So when we are looking at small cap like returns, you will also get small cap like volatility, which creates risk management difficult in this high potential zone. So let's take four historical examples of how this index performed. So we are now talking about only Nifty Next 50. So in 2000, February 2000 to September 2001, I am sure most of you would not be in the markets by then, as a lot of young folks are probably watching this video. But the dot-com crash happened in the year 2000, where it was a global crash, and tech stocks and telecom stocks boomed like nobody's business in the years 98, 99, and early 2000. And then the collapse happened globally. Nifty Next 50 in that phase dropped 78%. Can you imagine large cap index falling 78% within a matter of a year and a half, right here? Then the next big hit came in the GFC crisis, the global financial crisis. Here again, you saw Nifty Next 50 drop 72% in that period. Of course, the rally from 2003 to 2008 was also very impressive, but a 72% drop in index means individual stocks, some of them perhaps dropped 90%. Some may have dropped 50%, but others may have dropped 90%, 95% also. And that kind of a behavior of a stock certainly doesn't gel with the idea that it's a large cap stock. The the sort of narrative that is built around large cap is that they are safer. They will not drop as much. They are the blue chips. But that's not what we see when we actually see the data. Again, in November 10 to December 11, we saw a 32% drop in the index. And then more recently, which you all of you may have experienced, is the 36% drop in the March 20 COVID crisis. So the idea here to show you these data points was that even a large cap index, which which one would not associate with this kind of volatility, can really drop like a very significant volatile index. So if the index itself is seeing sharp drawdowns, individual stocks, you can imagine that anything can happen to individual stocks. So from a risk management perspective, this is not giving you any comfort versus, let's say, a small cap index, for instance. And hence, a strategy is needed so that you can create a system where you can get out of weakness. What happens is that, let's say, you are invested in an index and the index goes up and you ride that index up. When it is coming down, either you should have a strategy that you should be able to cut your loss somewhere. Otherwise, whatever you gained can get lost. The other strategy is that if you are wanting to go one step deeper into that index, then you need not buy all the stocks of that index, because the index is also made up of strong stocks and weak stocks at any point of time. So the ideal way is perhaps to look at only the strong stocks of the index. So a strategy is needed. Basically, you just can't buy the index and forget about it. Yes, that also will give you returns over a long period of time of 10, 11, 12%. But if you are really looking for, generating more alpha from that, then that, buy it, shut it, forget it strategy doesn't work. And you also need to be very nimble and efficient in discarding weakness from that index. So what is the recipe for a large cap investing that can be really be successful is to extract alpha from those large caps when the markets are going up. And then, when the markets are not in your favor, you need to do some aggressive, robust risk management of your holdings. So that's where, we have a product which is MINNF10 comes into the picture. And this, to explain you how this works, is that, let's say these are the 50 stocks in the Nifty next 50 index. Now at any point of time, there will not be, all the stocks which are really outperforming or doing well. So typically the makeup will be that 10 stocks out of 50 are really doing well. 20 stocks out of 50 are somewhere here and there, nothing great to talk about. And 20 stocks will be those which are actually weak and pulling the index down. So the index is made up of a certain proportion of all these 50 stocks. So the 10 stocks in the green are trying to pull the index up. The gray ones or the black ones are just in the middle, and the red ones are trying to pull the index down. So that's why you would have seen many times some heavyweight stocks like HDFC Bank or ICICI Bank or Infosys. When they fall, they pull the index down with them, even if a lot of other stocks in the index are going up. So this weightage business also creates a lot of bias towards those stocks. And if those stocks are weak, then the index really cannot move. So the idea here is that you want to not only be with the best index, but you also want to, dissect the index and ride only with the top performers of that index. So the idea is buy those top performers, review after every some time, let's say a week or perhaps a month, and remove the weakness and bring in new strength. And what that will do is that you will always be riding the stronger stocks out of that index. And when that will experience any market decline, then you will automatically move into those stocks which are the best in that cohort. So if the market declines in a big way, you will move into defensive stocks. So like usually when market really declines hard, FMCG, pharma, perhaps even IT stocks they are called the defensive sectors in the market, where if everything else, the high risk stocks are going down, then you can seek refuge in them. So when the strategy will switch from weak stocks, let's say metal stocks, auto stocks, and let's say chemicals, they become weak, then the strategy automatically moves into FMCG, IT, and pharma, which are not falling as much. And this way, you basically remove the weakness from your strategy all the time. The main purpose here is to not let the strategy fall as much as the index is falling. Because when you go into a deep drawdown, it takes a lot of effort and lot of time to bring yourself out of it. And the perfect physical analogy in the real world on that is that, let's say you are walking on the road and you fall into a, let's say, a 3 feet ditch. A 3 feet ditch is not too bad. I mean, you will bruise yourself, you will, take a moment, but then you will climb out of it and start towards your journey again. Now, what if that 3 feet deep ditch was not a 3 feet ditch? It was a 20 feet ditch. Then there is a problem. Then, without external help or some additional help, you cannot come out. The same happens with the drawdowns of portfolios. When your portfolio goes into deep red, portfolio is down 80%, you need your base from where to where you've reached. You've gone from 100 to 20. Now, to go from 20 to 100, you need a 5x jump. That is very difficult to do. Index can do it because the index committee will come after 6 months and remove the weakness and put the stronger stocks in the index, and index will revive. But for a lot of portfolios which people manage themselves, they will be stuck with the same stocks that brought them down, and then they'll keep waiting for the same stocks to take them. That is the problem with a lot of portfolios. So the index also behaves like a momentum strategy where the weakness is periodically removed and the strength is periodically added. These strategies also do the same. So it's like a multiplier impact, that the index at the base level is also changing, and the strategy is also looking at the higher strength versus removing the weakness. So this strategy in particular, NNF10 that I'm talking about, this is suitable for those people who perhaps have tried large cap strategies, not satisfied, or perhaps they can thrive on high risk high reward approach because it's a concentrated strategy, choosing only 10 stocks, or you have exposed yourself to mid and small caps, but you didn't get that alpha that you have been looking for. So those are the sort of pockets which this strategy will go for. Now, another thing that you probably need to understand is that every momentum strategy is built around something called the casino math. What is the casino math? Is, let's say, over the span of 1 year, you do 100 transactions, and let's say 50 go right and 50 go wrong. You will probably say this is a very average strategy, it doesn't really make money. But what is important here is to see the 50 trades that were winning, how much were they winning? And the 50 trades that were losing, how much were they losing? This actually is the key. So, in your winners, even though the absolute number of winners and losers is the same, if your average winner wins a lot, but the average loser loses a little, when you bring these two together, you will still make a lot of money. So, for instance, there are two portfolios here as an example. In the first portfolio, let's say out of 100, 70 trades are winning. And in the second portfolio, only 30 trades are winning and 70 are losing. Let's say returns on the average winner in portfolio A is only 25%. So every time a trade wins, you make it 25% on that trade. In portfolio B, every time a trade wins, you make 90%. So we high returns on winning trades. And let's say every time a trade loses, we lose 65% here. And here in this portfolio, every time a trade loses, we lose only 20%. So portfolio A, you're winning a lot of times, but each time you win, you make only 25%. And each time you lose 65% on that trade. Portfolio B, you win not so frequently, only 30% of the time. But every time you win, you win 90%. And every time you lose only 20%. What, in your view, would have had a better outcome? That is something that you need to think about and even apply in your own portfolios and strategies. This is the outcome of this. The first portfolio, which had a lot of winners, still ended up in loss. And this strategy, which had very few number of winners, only 30 out of 100, actually made decent money at the end of it. All because you have to see what each winning trade is doing versus each losing trade. So this is how a usual trade distribution looks like in a momentum strategy, where some stocks, like if let's say these are all 100 trades in a year, some stocks will perhaps lose 20-30%. Some trades will lose. There will be a lot of stocks that lose 10 to 20%. But then there is significant number of stocks that will gain 10 to 30%, some at 50%, some at 100%, some at 139, 234, and there'll be few, but some of them will really strike out big because you've allowed winners to run. When the stock is moving up, you are not curtailing that move up. You're not saying I'm booking out my on profit because it has moved up too much. You're allowing the stock to fly as much as it wants to. And only when it has done itself whatever it needed to do and starts to come down and shows some weakness, it is at that point you say, okay, this stock needs to get out of my portfolio. So these stocks, which are perhaps just 10 or 15% of, or perhaps the 20% of stocks, you can say, are making up most of the returns, while others are just averaging out each other. So again, the Pareto's principle, which you all know, the 80-20 rule applies here, where 20% of the transactions are actually going to make you the winning uh, difference, and 80% will be just be average. So this is the sort of real math behind what happens in a momentum strategy. So can momentum predict bottoms and tops? No, that is not possible. Momentum basically, what it does is it follows trends. And once the strategy finds that a trend has been established, it will get into that stock. It may be late to get into that stock because let's see this example. The stock started to rise from 49.50 rupees, went to nearly 300. Now at that bottom, nobody knows that this leg is going to come. It's only after this trend is started to form that you identify that yes, there is an upward trend, and let's say you buy here, and then it goes up, it makes a top, then it starts to come down, and this downward trend is when your system identifies that yes, the top perhaps is made, and we need to get out. We can't be waiting for it to come down to a bottom like this. It is also possible that the stock starts to go up again and you may enter it again at that point once the re establishment of the trend is there. So there is a lag in entering and perhaps there is a lag in exiting from the top. And that is fine because if the bottom to top is 7 times and you make 2 or 3 times out of that in the middle, somewhere here you have made some money. That is totally fine. You don't need to have the buy at the bottom and sell at the top, because nobody can do that. As long as momentum is confirmed, you will go along with that. So there's a lag at entry and lag at exit. Some stock stories I can share with you. So some stocks will do nothing for years together. Let's say this example is for Trent. For almost a decade, it was in this range, and then something changed post 2016, and it went from 100 rupees to 7,000 rupees. Along this way, many trends were formed. Some more aggressive and perhaps captured by certain strategies who are watching those trends. Again, Hindustan Aeronautics, nothing for years together, and then a trend formation, and you are taking out some part of that trend. And again, depending on the design of the strategy, you may get in early or you may get in late, and so on and so forth. But the trend needs to be there. Here again, you are seeing, a downfall. So you are basically not interested in any stock that is falling. That is the key principle of momentum investing. You are only interested in stocks that are actually telling you that they are wanting to go up. So there is no guesswork. You are not guessing that, oh, maybe next year earning will be so much, or promoter has said that we are going to increase capacity next year, so perhaps market share will go up. There is no guessing game. You are playing as per the BBC principle, the Bhava Bhagwan che, price is God. The price is telling you that there is something happening in the stock. The stock has gone from 40 rupees to 100 rupees here. Something is happening. You better ride this trend. That is the part that is important, is that you listen to the stock. In conventional investing, you are basically making your own assumptions, that I assume that this stock is going to go from here to there. The stock is not going anywhere, but you are assuming that. Here, with this strategy, you are not assuming anything. In fact, you are not even a part of the decision. That the strategy of following trends is taking the decision, and you are following that decision. You are being a very nice disciple of the strategy. That yes, if the strategy tells me to buy, I'm buying. If the strategy tells me to sell, I'm selling. I'm not putting my mind whether this company can do well or not, because that has a lot of assumptions, that has a lot of noise, that has a lot of error from what you've heard about things. Do you think people who bought here were not smart, who bought at 140 and then probably sold off at 40 rupees? They were also smart, but the trend was not in their favor at that time. So be very conscious about, whether you want to lead the market in terms of guessing work game, or you want to follow the market and enjoy the trends. So again, this stock established trend near 84 rupees, and you can ride it all the way up. Bharat Electronics is another case. It hit a high in 2008, and then again in COVID time, it came to the same price. Can you imagine? Over 13, 14 years. And then from there, it went up like 25x in just a matter of 4 5 years. So getting that trend right is the key. Bank of Baroda not moving anywhere since 14 years, from 2011 to 2024. But a trend was formed here, and you could ride that trend for some time, perhaps make some money. So the strategy summary here is that Nifty next 50 is that space which is very exciting. It is large cap, as quality names are there. It is not fly by night operators. You use 10 stocks out of those 50 and put them into a momentum strategy. You put 10% exposure per stock. Every month, you review the strategy. If there is any weakness in any stock, you will remove it. If there is strength in that stock, in any other stock from that cohort, you will add it to that. And you will basically have a long term outlook, so that when a market has a complete bull cycle, you will be able to ride that cycle in a big way. So that's my sort of presentation on this. I'll open it up for Q&A, and if you have any questions, I'll be happy to take that.
Sir, this webinar was truly insightful. I'm sure we've all learned something about large cap and small cap indices and how it can be beneficial. Before we conclude, I'd like to open the floor for any questions from our audience to be addressed.
I can see a couple of questions, but uh, uh, I will not be able to take any stock specific questions, that is restricted. But if you have in general about strategy, about momentum, about this index, that I'm certainly uh, happy to take up. So Ravi Chandran has a question. He says, "Can I buy junior Bs in SIP mode?" So yes, junior Bs is basically this Nifty Next 50 index, and if you buy it in a SIP mode, you are basically sipping into this index, and which is a high growth index. So over a very long period of time, I'm sure it can do well. Uh, Arvind Singh says, "How do we select the momentum stock?" So again, just like let's say conventional investing, there is no one way of. Some practitioners use the indicators like RSI, for instance, which stock in a cohort has relative strength, which is the highest strength. Or some people may use nearness to all-time high. So which stock is near its all-time high? I want to use that as a ranking for selecting stocks. Some practitioners may use a percentage change from last 3 months or whatever period to use, I mean, which is the highest percentage change of that period that will come into my momentum portfolio. So no one way, but essentially all these ways are pointing towards trying to rank stocks in a certain way so that there is objectivity and data driven uh, selection of stocks. It is not because some expert is telling you on TV that you should buy this stock, or because some price earnings ratio has gone down. All that is basically a guessing game. This is actual mathematical data driven strategy. Uh, Individual stocks, certainly I will not be taking. Can you suggest next Nifty Next 50 based mutual fund scheme? I am not very up to date on mutual fund schemes, but there must be plenty. So every mutual fund scheme, or it's best to go for an ETF actually, which will be lower cost if you want to go for Nifty Next 50. But if you want to beat this index, you will need a strategy like this. I'm still waiting for a non-stock. I really cannot give any advice on any stock or sector. Uh, I can take up any conceptual questions if you have. Any other question which is not a stock or a where is the stop loss kind of a question? So Sonu is asking, how do we assess most potential stock of next 50? Again, as I said, there are many ways of doing that. If you just rank those 50 stocks basis whatever strength that you want to choose, like let's say somebody says relative strength indicator. So each stock, where is the relative strength of that, and then which is the highest strength stock? Or some may say that which stock has moved the most in the last 6 months. I want to choose momentum basis that, and that can be the way in which you rank uh, those stocks. How many? I'm not getting the question here. I'll move to the next one. What can be the possible bottom? Okay, I really can't comment on the current market situation or stocks, please. Captain Ambika says, please explain RSI in detail. So RSI is basically a technical indicator which is taking the measurement of how the price is moving versus its average of the last, let's say, 14 days. So stocks that are moving up continuously will have a high RSI. Stocks that are moving down will have a lower RSI, and basically it is telling you how the strength of that stock is. There's if you can Google it, there's a lot of information about relative strength and RSI. Where can I find Nifty Next 50 most technical indicators value as in one page to compare? So any market data site, perhaps Money Control, perhaps ET, I'm sure all of them have significant or some specific dedicated technical sites like, for instance, Trendline is there. Um, I'm not sure if Screener has the technical information, but Screener also is could be used. Or you can use a software like TradingView, which can give you a lot of this data. So data is available plenty of places, and mostly free actually. This basic data is available free at most places. So typical cyclical time for the market is 5 to 7 years. That's how you basically see a boom bust cycle. Um, for instance, in 2000 we saw a boom. Then the next boom came in 2000 by 2008. Then the next one in 2014. Then post 2020. So there is a 5 to 7 year, maybe perhaps sometimes 8 years gap between one cycle to the other. So that period you will experience the going up and coming down of the stock. Shiv Prasad is saying, can we invest in Nifty Bs and Junior Bs for long term? I think yes, you can do that. It will give you perhaps better than Nifty returns. Uh, and because of this nature of the index, which is also momentum in nature, as I mentioned in the presentation, that the index components will keep changing if some of them are getting weaker. So that ensures that the index will never be allowed to be stagnating for too long uh, in that part. Nilesh Jain says how to track RSI of a stock. So many technical sites are available where you can put the stock name and it will give you all the technical indicators. The names I just mentioned, uh, Trendline, TradingView, many of them. Bank and Money Visayam says, is there any committee for next 50 stocks? So NSE has a company which is managing all these indices. So every index will be looked at by these index committees, and every 6 months there are changes that are recommended in those committees. Niftyindices.com is that website where you can go and see the current index and information about any change that is going to happen in the index in the coming months. Are SIPs available for Nifty Bs? Yes, SIPs are available for Nifty Bs. Some folks are asking about the current market. Sorry, I cannot take up those questions because there is no prediction that we can do on the markets. We are basically followers of the BBC principle, as I mentioned. So as markets will come down, we will gradually move towards defensive stocks or go into cash. And as markets will go up, we will again start to allocate. So we are following the markets and not trying to preempt the market. Nobody has been able to preempt and time the market to perfection for too long, ever. So might as well, use the market mass knowledge and trends to ride those trends and then to get out of those stocks once those trends are over. You don't have to love and hold the stocks forever. Achyuta Ramaya says, thank you for this well appreciated and research like observation. Thank you so much for coming to this webinar. I hope somebody can take away some good feature of momentum investing into their investing style. And essentially, there are only four things. These four things should be clear to you: what to buy, when to buy, how much to buy, and when to sell. If these four questions are answered for you, you will never have a big problem in the markets. Again, I'm saying what to buy, when to buy, how much to buy, and when to sell. There should be crystal clear clarity on these four questions. There should be no ambiguity. What to buy, there should be a way in which how you're selecting stocks, not because you're watching it on TV or somebody's telling you. So that becomes the what to buy. When to buy, what is that situation of that stock? In what trend is it right now? Whether it is a buyable stock or not, or we have to wait for that trend to form. That takes care of the when. How much to buy is also very critical because some people will put in 60% of their money into one stock and ruin their portfolio. So, very the easiest part is you can keep it equal weighted. If you have 20 stocks, allocate 5% to each stock. That takes care of how much to buy. And when to exit, the most important part of this equation is you should be clear before you enter the stock what will make you exit the stock. Are you looking for a, a certain percentage of profits? Are you looking for a certain percentage of growth in the company? Are you waiting for a certain period of time? Because when the stock starts to fall, at that time your brain will go dead. You will not be able to take a rational decision and you may exit in panic. So exit decision needs to be taken before you enter the stock, that if this condition is met, I will exit the stock. And I will not be emotionally tied to that stock that I bought it and held it for 3 years. I didn't make money, so why should I sell it now? I'll hold it for 3 more years. Don't do that. Your opportunity cost of money is really big. People sit in dead stocks for years together, not realizing that they could have just moved that money to somewhere else and made up significantly more capital. But this ego and this love for the stock, that no, I will not leave this stock till it gives me profit, till it comes back to my price. That is the biggest problem of most investors. So have these four questions very, very clear in your mind. If you don't have this clarity, don't invest directly. Please follow some investment advice, take some mutual fund, small case portfolio, PMS, whatever you may choose. Let a professional manage your money or advise you on that. If you are not capable of managing your emotions and if you are not capable of taking non emotional decisions. A lot of question about defense stocks. Again, it will depend upon why you bought them. If you bought them because they were going to get a lot of orders, so orders are still flowing in. Perhaps in next 3 years they may come out with some fantastic results. So again, I'm saying, if you bought defense stocks and you didn't know why you're buying, getting out is going to be very, very difficult because now you have no exit plan. It's like you have boarded the bullet train, but now you don't know where to get down and how to get down. So this entire thing has to be seen in the entirety of, it's like a complex equation that needs all those answers before you start. And 99% of the people have no strategy. That is, I mean, they will make money in the bull market and they'll lose most of it in the next wave down. Then they'll make it again, then they'll lose it all again. At least some fund or some small case or some PMS, some AIF, at least some professional manager can perhaps do better than that. At least they have some strategy. Um, so I think there are no more questions. If you like, we can come to an end to this webinar.
Thank you, sir, for your insights. We surely found this session knowledgeable, and I hope the audience liked it as much as we did here. Your expertise and passion for this subject were evident throughout your talk. We appreciate you taking the time to share your valuable insights with our audience. Thank you so much.
Thank you and have a great investing journey ahead.